Hope everyone's doing well. This is the Emini review for Monday, July 1st, 2024. And it's the first of the month, so we're going to look at the monthly chart first. You can see June, we had a bull breakout. This is June. We have a bull breakout of all the bars to the left, a close above all the bars to the left, consecutive bull bars, good for the bulls. But there's actually a significant amount of overlap with the June bar and the May bar. So only this much of the bar actually broke out. So from here down was all overlapping the prior month, the prior 3 bars. And that's trading range or channel behavior. So I think it's possible this isn't a very strong bull breakout. Maybe it's 2 or 3 legs up. And maybe the market pulls back, tests the breakout point this high, maybe this high. Maybe it happens this month, maybe next month. But we're getting increased sideways price action. And it's possible this is a late leg, which would lead to bulls taking profits, aggressive bears selling, at least for scalps, and possibly getting tests of breakout points. And then if we look at the weekly chart, it's Monday, first day of the week. It's more clear the market's going more sideways on the past 2 weeks. You can see these bars have small bodies and big tails, and last week was completely inside the week before that. So that's an inside bar. It means the range is contracting. It's a trading range. You can see we already fell below the low of last week, and then we reversed back up. I'm expecting trading range price action this week because of where we are in this tight trading range. And if we do go above the high of last week, I'm expecting sellers above. You could view it as a high 1. It's a weak high 1, bad context, weak signal bar, high in a tight trading range. So probably sellers above. And I mentioned before breakout points. So maybe the market falls a little further, but if we fall below here, that's a bad stop order sell signal bar. Here's a breakout point. Here's a breakout point. So the market is probably more likely going sideways. And then the daily chart coming into today, we had that outside day on Friday. It's mostly clear here that the market's in a tight trading range. So we had that outside bar, but look at the context. We're in a tight trading range. Outside bars are trading range bars. They're expanding triangles. So the low of an outside bar is usually support, and breakouts usually don't go far. And if they do, they typically come back and retest the low of the bar. And the same goes for the high of the bar. Usually resistance. Breakouts usually fail or fail to go far before retesting the high of the bar. So tight trading range, maybe 2 legs down, 1, pullback, 2. Plus, look at this breakout point. You had this stop order, buy signal bar. It was a weak bar, consecutive dojis. Then we had this big bull breakout bar and follow through. Bears got trapped here. So if the market comes back and tests this red line, that's the high of this bar this day, the 14th. If we come back and test that price, there's probably disappointed bulls looking to buy back shorts. Disappointed bears looking to buy back shorts. And bulls know that, so they'll look to buy as well. Over here, the price is 55.07 and 3/4. So I have that drawn on the 5-minute chart as well. We'll get into it. We gapped up a small gap into the day today. And it's possible it's 2 legs up, and you can see it as a nested 2 legs, maybe leg 1, pull back, leg 2, and then here, a couple bull bars, leg 1, a pause, and then leg 2 on the gap up. The open of the day is where you can imagine a bull breakout bar closing. So we closed or rather, the day opened here above this swing point, and that's good for the bulls. It got above a prior lower high. But at this point, the market's more likely in a trading range than a bull trend. Look at all the overlap, and it was a bear trend coming into this trading range. So the odds are there are sellers above swing points and buyers below. Bar 1's a trading range bar. Not a very exciting bar for the bulls in this context. You probably have sellers above the bar, and as far as buying below, some traders might arguing it's a bad stop order sell, and maybe bulls will buy for a scalp. But bulls buying below bar 1 are expecting just a scalp, not a swing trade. Bar 2, we have an inside trading range bar, consecutive bear closes, and now we have a high 1 at resistance. Remember this line? It's a prior lower high. We have a big down, big up, big confusion. Market's likely in a trading range. And in a trading range, traders sell high and buy low. So we're high. We poked above it, tried to break out, and failed. Now bar 2 is a high 1 signal bar. Probably sellers above bar 2. And then bar 3 continued to the downside. Traders sold the close of 2. And we're getting a small breakout bar on bar 3, crossing the moving average. 3 consecutive bear bars. The odds are there are sellers above. Maybe the bulls get a small second leg. Leg 1, pull back. Leg 2, but the best case scenario for the bulls here, the bulls who bought on the open are disappointed. They'll use any rally to get out of their longs. And then it's a 3-bar bear micro channel, and we're fairly high in this trading range, so probably bears looking to sell above as well. And then 4, we have a breakout bar. Might be a sell vacuum. We're in the middle of a trading range, but strong enough breakout for the bears that any pullback is probably going to be minor and lead to a second leg down. Trend bars in trading ranges, like bar 4, especially in trading ranges, tend to lead to 1 to 3 bars of sideways. You have bears who sold higher. Maybe they sold the breakout point, this red line. Maybe they sold up there and they see bar 4 as a gift and they look to take profits. Bulls, we're getting a sell vacuum, test of support, maybe the bar 79 low, but we're not quite there, so we may go a little lower before we get there. And then bar 5, it's minimum follow through for the bears, so it's a doji bar. The bears prevented a bull body, so breakout and follow through. Now we have 5 consecutive bars in a micro channel. Bar 5 is not a strong setup for the bulls. We have a double bottom with 78 and 5, but there's a lot of selling pressure, not a lot of buying pressure in a weak signal bar. Probably sellers above 5. 6, we have a bull trend bar, and you can view it as a buy vacuum test of resistance. What are we testing? We're testing the moving average. We're testing the breakout point, the bar 81 low. The market broke out below it. We're pulling back, testing this area. Even though bar 6 is a bull trend bar, compare it to the size of bar 4 and look at the context, and you know that bar 6 might be fairly high in a trading range after a strong enough leg from the bears that we're probably going to get a second leg to the downside. So bar 6 is more of a sell the close bar. And then this bar 7 was disappointing for the bulls. The bulls were hoping we would rally and get another bar on bar 7, just like bar 6. But instead we have disappointment. Disappointment is the hallmark of a trading range. Remember that there were bulls who bought earlier in the day. They got trapped. So any bounce, any rally, the bulls are going to take profits and try to avoid a loss. And that's why rallies lead to selling in trading ranges. Bar 7 is a low 1 short, but in the middle of a trading range and a weak signal bar. There might be more buyers below 7. Overall, the market is sideways. Inside bar on bar 8, bear reversal bar closing on its low. The bulls, maybe they'll look to buy lower. Maybe this is the start of a second leg down. Leg 1, pull back, then maybe leg 2. 6 was strong enough for a second leg, and you can argue that bar 8 was the second leg. So bar 6, we rallied even further on 7, pulled back, and then here, from the close of 7, we rallied on 8 and then reversed down. So the bulls have 1, pause, 2 legs up. That's the bare minimum second leg for the bulls. So now we have a second reversal on a lower time frame chart. We're expecting lower prices after bars 1 through 5. We're expecting sellers above 5. And that's what we're getting here. But the market is overall in a trading range. And if I just scroll down a little, here you have this price. That's the daily chart support that I drew here. This breakout point. Here's the outside bar, coming close to it, testing near it. And then that's what we got on bar 9. Sell vacuum on bar 9, testing pretty much exactly the high of that bar, June 14th. And look at the breakout. It's a big bar. It's a strong bar. It's basically a shaved bar, no tails above or below, but the context is bad. And you have to ask yourself, how far did the breakout actually break out? And ask yourself, breakout of what? So breakout below this swing point, the bar 73 low, and then this support, which is this high over here. And you can see the market broke out of that by a tick. So the bears really hardly have a breakout. They need another bar, preferably like bar 9 on bar 10. The bulls see it as 2, maybe 3 legs down. Sell vacuum test of support. And aggressive bulls will buy the close, betting on basically perversion to the mean. We have a trading range here. Market mostly sideways in this range. The midpoint of that range is going to be a magnet. It's a fair price. And then 10, no follow through for the bears. Bulls by the close of 9, they get 10. They probably look to scalp out. It's unlikely that a bull trend starts from bar 9, but bar 10 is strong enough that any bear that's short, betting this is a bear trend, well, now we have a possible major trend reversal. The market went sideways, and a possible final flag. Here's another bear breakout, and then a strong reversal up on bar 10, a lower low, double bottom with here, and then again at this support. Bar 10 is a problem for the bears. At this point, the market's today is probably going to be a trading range day. You look at all the overlap, and then from today, 2 legs down, but good buying pressure here, good buying pressure here, and a failed bear breakout of yesterday's low and the June 14th high. Sideways on 11, bulls who bought 9, scalping out, taking profits. And we're totally inside the range of bar 9, so this is not the ideal bull breakout. Bulls would rather buy a pullback, or in other words, buy lower. You have bears who've sold the close of 9, front running the breakout. Those bears are trapped. Now the reality is bar 9 is strong enough for a second leg down. And on that second leg down, bulls will look to buy and bears will look to exit their losing position. So you'll have bulls and bears buying down here. And it's probably low in a trading range. You can argue it's still a bear trend. We have lower lows, lower highs. But here, the market rallied above a lower high, and this looks more like a trading range to me. 12, a small bull bar. It's a bad low one short. But for the bulls, we've had a couple of bars sideways. Really the past 4 bars, big down, big up, and then sideways. The market's in a trading range. Again, bulls would rather buy lower. Bears might sell here for a scalp. The market's testing a breakout point, the bar 5 low, and anywhere in here where the bulls, maybe bulls bought below bar 6, got trapped on 9, and the bulls are exiting, the bears are shorting. And then 13, you can see traders were selling. Bear breakout on 13 might go a little lower. It's a bear bar closing on its low, but the downside might be limited, and that's because of the disappointment that bar 10 gave to the bears, who sold at close of bar 9. So you have trapped bears down here trying to get out at break even, and if they're able to get out at this price level, they'll take it as a gift. 12 is a bad low one short signal bar, and so bulls might have bought below 12, got trapped on 13. This price might end up being resistance if we come back and test it later. And then 14, look where bar 14 tested. So on the close of 13, we closed at the low of the bar. But again, look at the context. Big down, big up. This bar is in the middle of a trading range. It's so common to see that you have a sell vacuum or a buy vacuum or a sell vacuum testing a magnet, maybe in the middle of a trading range, maybe a 50% pullback of bar 10. So bulls might buy there for a scalp, and like I mentioned, you have traders who did not sell below 12. You had bulls possibly buying below 12. You had bears not selling because it's a bad signal bar. So now after seeing the breakout on 13, bears might look to sell with limit orders right where bulls are looking to exit their losing longs, and that's what happened on 14. Now we have a bear breakout and follow through, 13 and 14. But as always, I always go back to it. Think about the context. Bear breakout and follow through, but the follow through bar overlaps the breakout bar by about 80%. And then just look to the left. Big down, big up. It's a trading range. We're in the middle of a trading range. We might go a little lower. There's momentum to the downside. But the way I see it, the reason the market's going lower is to find bulls who are willing to buy. The bulls aren't interested in buying in the middle of the range. They want to buy lower. So the market might be selling off, but it's probably more due to bulls stepping aside than bears selling aggressively, because the bears know the market's in a trading range, and this is the lower third. On some time frame, bar 14 pulled back, so we have a low one short on 14, so we have a low one, low in a trading range. Usually there's buyers below a bar like 14. Plus you have the support here, this line. Basically the close of 9, I'm going to keep it as the high of bar June 14th on the daily chart. And then 15, we tested that price again and then reversed up. We have a bull bar closing near its high, only a small body. And the sell-off from 13 to 15 is tight enough that the first reversal up will probably fail. 15 is not a great signal bar. It's basically a trading range bar. But you can see bulls and bears both buying at this price level. So it is possible we reverse from here, but typically you get a stronger signal bar than 15. It's possible we have bears selling above 15, looking for a scalp, maybe a second leg down. It's a nested second leg, so leg 1, pull back, leg 2, but the second leg might be strong enough for its own small second leg. So that's the danger with buying above 15. And if you do buy above 15, you have to be willing to scale in lower, which means your stop cannot be below 15 or bar 10. Your stop might be a measured move down, maybe from 12 to 10, somewhere down here. Betting that this is a trading range, there's traders buying below bars, and that's why having your stop down here is illogical. That's where strong bulls are buying, and that's where strong bears are taking profits. So it doesn't make sense to sell there. Inside bar on 16, so we did not trigger the buy above 15. And it's an inside bar, so trading range on a smaller time frame. And again, it's a low one on a smaller time frame chart. We sold off, pulled back, and we are reversing down again. But again, we're testing support. So there might be more buyers below 16, even though it's a good-looking bear bar. The context makes it probably a better place to look to buy than to sell. And then again, 17 looks a lot like 13 and 14. Bear breakout, and then the follow-through has a big tail, and it overlaps the breakout bar by about 80%. Also, 16, it's an inside bar, so it's actually a non-breakout bar. You always have to think about the market cycle. And so now at this point, we might have 3 legs down, like this. 1, pull back, 2, pull back, 3. The second leg subdividing into 2 legs. And knowing the higher time frame context, like the daily chart, doesn't hurt. So in this area, usually better to look to buy your low in a trading range. And any bear who is short is probably looking to take profits. Think about if you were a bear selling the close of bar 9, and then you get this bar 10. If the market comes back down to your original entry price, you're going to take that as a gift and basically say thank goodness and buy back your short, look to sell maybe higher in the range. So then we had an outside bar on 18, failed breakout to a new low of the day, and then a reversal up, but the bar could not close above the prior bars. So it's a failed bull breakout attempt. But bar 18, I always say with outside bars that outside bars are trading range bars, and that is true. But there's also always a context for a good outside bar and a bad outside bar. So like I said earlier on the daily chart, outside bear bar but low in the range, testing support, probably better to look to buy the low of that bar. So with that logic, you would expect me to say that bar 18, it's a trading range bar, outside bar, expanding triangle on a smaller time frame, so better to look to sell above the bar, look for a second leg down. And again, the problem is context. So in this case, we have a possible wedge bottom. Bar 18 could be the start of basically the market cycle resetting and could lead to a breakout that would be classified as leg 1 and then having a high probability of getting a second leg. If you're selling above 18, you're betting on a low probability event. You're hoping the market triggers the buy, traps the bulls, and then sells off like bar 9 all the way down here. The reality is that the bears got to this level and then got a deep pullback, got back here, deep pullback, getting here again, and now we have an outside bar. So the bears, they might be exhausted, and they may not look to sell for at least 10 bars in 2 legs, sideways to up. Because of that, the bulls will look to buy. Inside bar on 19 is a bad low 1 short, probably buyers below. As far as selling above it, it's an IOI pattern, breakout mode. But like I said, because of the context where the market is, it's very possible this is a wedge bottom. And lots of overlap in here. These look more like bear legs in a trading range than bear legs in a bear trend. So what follows? Bear legs in a trading range, a couple legs down, then maybe you have a couple legs to the upside. So that's the danger with being short down here. Even with this bad signal bar 19, you will have bulls buying above it because swing traders with these more major patterns, the patterns made up of more bars, like 3 pushes down like this, signal bar is way less important. It's more about the context and the energy of the market. 20, we broke out above 19, pulled back immediately. It was an inside bar, low probability of a breakout, and look at all the bars sideways in here. It's a tight trading range, so buying here, not necessarily high probability. You have bears selling above bars. You have bulls who bought down low, looking to scalp out above bars. Now it's a possible 3 pushes up. One, 2, 3. But this pattern is made up of about 5 bars. It's more minor. So maybe we fall a little bit lower, but there's probably buyers below 20. Bad low 1 adds support, bottom of a trading range. Instead, traders bought the close. 22 is a trend bar. Bull trend bar closing at the moving average. Would have been better if it closed above. But now we have a micro channel since 18, probably buyers below, and probably strong enough up for a second leg. Some traders see it as 1 pullback, 2 legs. Maybe we have a deeper pullback, and bulls look to buy the pullback rather than the close or above bar 21. 22, inside bar looks like a minor pullback, testing the high of bar 20, a breakout point. Bulls might buy that as a high 1, by the close of 22, stop below 18, looking for a couple more legs up to the top of the trading range. The bears, they can sell 22, betting it's a low 2, but the low 2, the low 1 did not trigger on this chart. It's a pretty tight bull channel with a couple decent bull bars and still at the bottom of a trading range. You can see the bears, every time they got here, they were not willing to sell. We're not getting bear breakouts here. So if you are selling, you're selling for a scalp. 23 fell a little bit lower. It's a bad high 1, consecutive bear bars, weak signal bar, but still low in this overall trading range. So bulls who bought or who are buying have a stop below 18, maybe even a measured move down, and they'll look to buy lower, below 18, and they're looking for a reversal up. This is a context where the market might be always in long, even though it's not very clear. It's a trading range, so buy low, sell high. But the market's in a trading range, and it's low in the trading range. So down here, the bulls are long, looking for tests of higher prices. The bar 1 high, for example. Bar 1 remains the high or the low of the day about 20% of the time. So that's going to be a test target. And then plus, by bar 18, there's an 80% chance we've seen the high or the low of the day. It's possible we have a bar 18 reversal today. Maybe a wedge bottom, and then here's your early swing of the day, low of the day, and we test above bar 1. And then 24. Bar 24 is a shaved bull trend bar. Now some traders will see it as 3 pushes up, 18, pause, 21, pull back, 24. So we have 3 buy climaxes testing resistance. So this is not the ideal place to be buying. Why is it that the latest bar in this rally is the strongest bar with no tails and a big body? That's always suspicious. The fact that it's a third leg and a possible double top, you will have bulls taking profits on the close of 24, seeing it more as a gift. It's easy to get trapped into buying bars like 24, but at the very least, when you see a bar like 24, you at least want to see a follow-through bar, even if it's like bar 12. And so that's what traders will look to see. And then 25 was not minimum follow-through for the bulls. Instead, it's a bear bar, so we have 1, 2, 3 buy climaxes testing resistance. Bulls who bought here earlier got trapped. They're going to take profits on a retest. So it's possible we have a double top here. And the market pulls back. You can argue, even though the shape isn't really technical, it's not a parabolic bull wedge here. 1, 2, 3. It is a wedge, but it's not really parabolic. But this is probably a breakout on a higher time frame. So the expectation here is that the reversal will be minor. So we are expecting a pullback or a minor reversal after 24 because it's 3 pushes up to resistance. But bulls will buy probably below bar 24, maybe even lower if we get there. Outside bar 26 triggered the high 1, which was bad, 3 pushes up in a bad signal bar. Sellers above for a scalp, and that's what we're getting on 26. 26, outside bar. Expecting buyers below, but we're not sure exactly where below. This might be strong enough for a second leg down. And then 27 actually is the second leg down. So outside down 26, we pulled back all the way up to the bar 27 high, and then we closed on the low of 27. That's 2 legs down on a smaller time frame. And that might be all we get after this parabolic wedge. Al usually says your expectation after a wedge is 10 bars, 2 legs. But when the wedge is only about 8 bars, the correction might only be 3 bars before there's continuation. Bull bar 28. Some traders will buy above it, betting it's a high 2, even though it's a high 1. Actually, it is technically a high 2. We did trigger the buy above 25, pulled back. Now we are reversing back up above 28 with a decent buy signal bar. The bears had a chance to reverse here. They failed. They're looking for a second reversal. And then we got bar 29. Is that the second reversal bears are looking for? Of course not. It's consecutive bull bars, both with really small tails. So bears who sold here, anywhere in here, might be getting trapped on these bars. And if the market is in a trading range, those bears might look to exit, look to sell higher in the range, like prior swing highs. So we fell below 29 on 30 and then reversed up. The patterns are fractal, so now you can see it as 3 legs up in a different way. Maybe rally to 21, pull back, rally on 24, pull back, rally up to 30, and then this was 2 legs. We technically pulled back on bar 30. So bar 30, similar to 24, not the ideal place to be buying. Bulls might be taking profits. Still might be a double top with bar 12. Bears, they see consecutive buy climaxes, maybe a late leg in a trading range. So they'll look to sell the bar 30 close for a scalp. And that's what we got on 31. 31 might be all the bears were expecting and all that they will get. Could not close below the moving average, so the moving average is support. We broke above it on 24, pulled back below it, but then broke above it again, tested it on 30, reversed, testing it again on 31. The bulls looking to buy the moving average test. And then 32, another big bull bar, but again, the fractal nature of charts. 24, 32 is similar to 24, where maybe it's 3 legs up, and we have the best looking bull bar on 32. Where's 32 testing? The bad low 1. I forget if I mentioned it, but bar 9 was a surprise. This bar, the inside bar, was not a great sell for the bears. So you had bears who did not sell here. You had bulls who were long or maybe buying below here, and they got trapped on bar 9. So on a retest, we're vacuuming up to that price, or at least around that price. The expectation is resistance and more sideways to down. 33, so we have breakout and follow through. 32, 33, but still in this area that might be resistance, possibly high in a trading range, a couple legs down, a couple legs up. Is this leg 1? Is this leg 1, pull back, leg 2, or is it leg 1, pull back, leg 2? That's always the question, is whether this is leg 1 or if it's a pullback and leg 1 was here. And it's usually pretty subjective, especially in a trading range. You can view it as a bull breakout, deep pullback, and then a channel, spike and channel bull trend, testing resistance high in a trading range. So the market might be overall in a trading range, and that's what it looks like. So at this point, we're expecting sellers above bars for scalps and maybe a couple legs down. The market's channeling up. We have a small spike in channel. 32 is the spike. Pull back on 33, and the market's channeling up on these 2 bars. And we might start to pull back and go more sideways and then test the bar 33 low. So spike and channel and then evolve into a trading range. Small bull breakout 35, but immediately failed and reversed. What about selling below 35? The problem with 35 is that 3 consecutive dojis, the market's more likely in a tight trading range up here with buyers below 33. So if you do sell, it's for a scalp. Tight enough channel that any pullback is probably going to be minor and lead to a second leg up. We have a bull trend line, so you will have bulls buying the trend line as well. 36, bull bar closing on its high, but 3 or 4 bars really sideways. We don't know how 36 formed. We don't know if the bar started on its low and then slowly creeped up to its high, or if it bounced up and down, up and down. Because of the context, I'm willing to bet that it was not a very strong building of the bar. Or in other words, if you look at the 1 minute chart, it's probably a trading range bar. Probably sellers above. Resistance to the left might be late in this rally. 37, inside bear bar, 2 bar reversal. Bulls might exit below 37. Aggressive bears, they might look to sell because the market is in a trading range, and now we have an open gap. Bears sell above 31, get trapped on 32. We rally a little further, but basically it's a spike in channel. The channel is expected to convert to a trading range, test the 33 low, maybe the 31 high. Bull bar 38, so very tight trading range with small bars here. Limit order market, traders are selling above bars and buying below, so there's probably sellers above 38. Inside bar 39 reduces the probability for a breakout even further, probably sellers above 39 and buyers below, but the buyers may not come in until down here. That would be my concern with buying up here, is that we might be late in the market cycle. Spike in channel, looking for a deeper pullback into an overall trading range up here. Outside bar 40, so we triggered the buy above 39 and immediately turned down. 40 is a second reversal, 37, and then 40. We did not trigger the sell below 37, but it is two bear bars, micro double top, and again possibly late in a spike in channel, and then a double top with bar 7 earlier. We might be getting close to testing the bull trend line, but it's a pretty minor trend line, and this looks more like a leg in a trading range. When you look to the left, we're not really breaking out of bars to the left. All these bars are overlapping. Follow through for the bears, 41, testing the bull trend line. Bulls might buy, but again the concern is the 33 low and the breakout point. In trading ranges, breakout points close, and this looks like a trading range. Even look back here, we did have an open gap above bar 19, but then look at the breakout above bar 22 on 24. You can see the market closed the gap. Here's the open of 22, here's the close of 27, so that gap was closed. Same with here, breakout point 30, here's the breakout point, breakout on 30, pullback, closed the gap. So this breakout here, even though it's a spike in channel, you can see the bulls are getting exhausted, unwilling to buy at the top of the range, unwilling to buy above bars in a bull channel. The market has to go lower to find buyers. That might be this red line, the breakout point. 42, maybe a high 2, high 1 above 39, pullback, high 2 above 42. You can argue it's a bull trend, but because the gaps are closing, you know the bears selling above bars are making money, and that's not good for the bulls. There's no fuel, no trap traders. So probably sellers above 42. It's late in a channel, high in a trading range. Outside down 43, probably going a little lower. Testing the moving average where we might find support, maybe 2 legs down, bulls buy, but they're probably buying for a scalp. The 33 low is so close, we're probably going to get there. And then the 31. Again, the bar 31 high is also a magnet. 44 fell below bar 43 and found buyers. It's 2 legs down in a very tight trading range. The trading range starting from bar 33. So here's the low of the range, maybe bar 33 low, up to the bar 40 high. Very tight range, limit order market. Most traders should not be trading. And if you are, you're buying below bars, low in the range, and selling above bars, high in the range. So probably buyers below 44. 45, we had a bull breakout attempt above the prior 2 bars, but it immediately pulled back. 45 is a low 1 short, above the moving average in a tight trading range, probably buyers below 45. 46, we tested near the low of 45 and reversed up, but 46 is possibly 3 legs up. And I know that might be confusing, but if you think about a lower time frame chart, we rallied on 44, pulled back, rallied on 45, pulled back, and then rallied again on 46. And I've said this a couple times today. Whenever the best bar of the rally comes late, that is suspicious. It happened on 24, deep pullback. And then it happened here on 32, which happened to get follow through. But how far above 32 did we actually get? Not very far. Within a half hour, we're back at your entry price. And so that's the problem with 46. There might be more sellers above than 47. A bear bar undoing all of the past three bull bars. Now it's possible we have three legs down, 37, 42, or 43, and 47. Maybe a wedge, bull flag, but to me the market looks more like it's in a trading range, not a bull trend. So some traders will argue bull trend and then a high three, and then look for trend continuation. To me, it looks like the market's in a tight trading range up here within a wider trading range, all these bars here. So in general, on the bigger picture, better to be looking to short up here. And if you are buying, you got to buy below bars. So bulls were buying below 44 on 47, 3-bar rally, micro channel, buyers below the breakout. And then 48, a bull bar, triggering the buy above 47, which was a bad stop order trade. You had sellers above 47. But if you did sell above 47, 48 is a bad entry bar, so you might get out and look to sell higher. Probably buyers below 48 and sellers above, but they may not come in until a new high. Inside bar 49 going very sideways. It is breakout mode. You can call it a triangle. But the worst thing you can do in this type of environment is to enter with stop orders. When the market's in a tight trading range like this, it's a limit order market. Traders are selling above bars and buying below bars. With a triangle, 50-50 chance the first breakout fails and reverses. Bull breakout attempt 50, but immediately pulled back. 50 is a bad stop order sell, so probably buyers below 50. Probably sellers higher in the range. 51 consecutive bull bars. Bull breakout and pullback, maybe continuation, but also possibly 2 or 3 legs up. 1, 2, 3, or 1, 2. High in the range, probably sellers above 51. 52, deep pullback. Still within the triangle, no major breakout of the triangle. Very tight trading range. All the bars overlapping one another. Again, it's a limit order market, and really, this is not ideal trading for anybody, even an expert. But the experts are selling above bars, buying below bars, and scalping. So 52 looks like a decent bear bar. It's easy to get hopeful. This is a weak bull trend, final flag, triangle, and then a good bear bar, sell below it for a swing down. But the reality is there's probably buyers below 52. And we can see that on 53. Disappointment. And again, just in the middle of this trading range. More likely breakouts are failing and the market goes more sideways. Bear breakout attempt 54, pulled back, two-legged pullback for the bulls. 52, pause, 54, low in the range. You had bears trapped on 47, trapped on 48. We're retesting that area on 54, probably buyers there for a scalp. And we fell a little bit lower on 55. Now we have 3 pushes down, 43, 47, 55. But still a very tight trading range. The ideal entry is buying below 47. It's not buying above 55. That's a bad stop order trade. Middle of the range, bad signal bar. Bull breakout 56. It's a bad bar to sell below. So there's probably buyers below 56. We might test higher in the range, but I do suspect there are sellers above the bar 40 high. Bull breakout 57, but did it break out? So the high of bar 40, the high of this tight trading range, is 55, 34 and a quarter. And the close of this bar, 34 and a quarter. So we closed at the high of 40. Would have been better if the bulls closed above it, even by one tick. But even if they did close above with one tick, it's just one tick. It's not very major. And even if they closed on the high of this bar, look to the left, we're still within this trading range and this major lower high over here. This is resistance. So the market's rallying and the range is expanding. We're getting a bull breakout, but the location is bad. The context is bad. You're high in an overall trading range. You're high in a tight trading range. Another bull breakout, 58, but a pretty small bar. So 56, small bar, 57, a bigger bar, but selling into the close. And then 58, another smaller bar, and probably 80% of that bar overlaps bar 57. That's a problem for the bulls. The best breakouts have very little or no overlap. So some traders will argue we rallied on 57, pulled back, got a second leg on 58. The bulls now need follow through after 58. And again, look where we are, top of this range, expecting resistance. Might be a buy vacuum that bulls use to their advantage to take profits, and bears see as a brief opportunity to sell at a great price. And then that's the follow through for the bull breakout on 59. And obviously that's not very good. The bulls will exit below 59. Maybe the bulls will hold on, scale in lower, looking for a rally, pullback, second leg, testing the high close of 58. That will happen if they're lucky. But other bulls might just take their loss below 59, and you'll have bears selling the close of 58, selling some resistance price over here, and they'll sell below 59. And then 60. A bear trend bar, it's a good bar for the bears, but the context is bad. It's very similar to 57, 58 for the bulls. Bull breakout, but bad context. Same thing here. Bear breakout, but bad context. Look to the left. You're at the bottom of a tight trading range. Bears who sold up here, they're going to scalp out, or they sold below 59, they're going to scalp out. Strong enough down for a second leg, and big enough disappointment that if we do get back to the 58 close later in the day, the odds are that'll be resistance. Bulls will look to sell there, get out of their longs, and bears will look to sell there to initiate shorts, probably sellers above 60. We went a little lower on 61 and tested this bear channel line, and we came close to the breakout point, the bar 31 high, but did not quite get there. That's a sign of strength for the bulls. The bears unable to close that breakout point after 1, 2, 3, 4 attempts down. The problem with that argument with the open gap is that you're saying the market's in a bull trend, and just look at the price action for the past 20 or 30 bars. It's been mostly sideways, consecutive big bear bars. This doesn't happen in a bull trend. So we might be in a trading range, and it's okay to buy low, buy below 55, buy the close of 60, scaling lower, whatever it is, you're buying low, but you're probably scalping. 62. Triggered the buy above 61, but more likely a minor reversal. After consecutive bear bars and a doji signal bar, most traders will not buy above 61. 62 is a low one, short setup, probably buyers below that bar. 63 going a little higher. It's possible that on a smaller time frame, bar 61 rallied, and then that was a bull spike, and then this is a channel. It's only a 3-bar pattern, but here's the rally, pulled back on 62, continued higher, pulled back, continued higher. That might be 1, 2, or 3 legs up after a bear breakout, expecting a second leg down. So some traders might sell above 63, betting that it's 2 or 3 legs against a breakout that should get a second leg down. But if you are selling, it's a scalp. You're not expecting a bear trend out of all this. 64, outside bar, but low in a trading range, probably buyers below 64. 65, inside bar, bull bar closing on its high. Second reversal up, bears will exit above 65, and bulls might buy above 65, looking for a couple of magnets, a test of the bar 58 low, that's the first one, and then of the close of 58. Inside bar 66, II pattern, breakout mode, probably buyers below. Selling above's okay for a scalp, but you're low in this tight trading range, so not ideal. Bear breakout attempt 67, but might be a late leg, maybe 1, 2, 3 legs down, tight trading range, low in the range. If it is a trading range, which it is, you have a breakout gap above the 58 low. It's very likely we come back and test that price. We may have to test this breakout point first, but you can see the bears have tried many times and we're just not getting there. What might happen? We've come so close to that target, the market might have a quick sell vacuum test and then reverse up to the other side. Bull breakout on 68, bad signal bar 67, but this was after the II pattern, so remember that's a triangle on a smaller time frame chart, and I said 50-50 chance the first breakout is the wrong way. So here's the triangle, bear breakout, failed, and we are reversing to the upside. We're still within this tight trading range. It could easily be a buy vacuum of resistance and then sell the close on this bar and we come back down. But there's probably buyers below 68, scaling in lower. 69 minimum follow through for the bulls. If a bull was buying 68, hoping for a breakout, another bar like 68, they're disappointed with 69. Some traders will see it as 2 legs up. You can see it a couple different ways. Maybe leg 1, 2-legged pullback, leg 2. Other traders might even see this as leg 1, deep pullback, leg 2. You're testing about a 50% pullback of this breakout. So this is resistance, middle of a tight trading range, not ideal to be in the market. Bulls might buy below bars, but then scalp out in this area. Bear bar 70, probably sellers above, tight trading range, not ideal to buy above or sell below. Consecutive bear bars 71, probably going a little lower, but probably testing support like the bar 67 low, maybe the breakout point, the bar 31 high, but you're expecting breakouts to fail. Just look at the past 30, 40 bars. Very tight trading range. Markets have inertia. You're expecting more of the same. So bear breakouts are expected to fail, and bull breakouts are expected to fail. Here's a bull rally, and then immediately failed. A couple bars down for the bears, went sideways. Bears trying again. Maybe we test here, but this is support. 72, bear breakout, but huge tail below the bar, and possibly a second leg down on 61, a couple legs sideways, and then a second leg. We're testing an area where the market rallied earlier in the day. The problem, it is 4 bars down, but the buying pressure on 72 is a problem for the bears. You can argue it's a bad stop order signal bar, and that is true. It's a bear body, big bar, so big risk, probably more sellers above. But because it's 2 legs down in an overall trading range, there's an increased chance we rally and have a deeper pullback. 73, bull trend bar, closing above the moving average. That's a problem for the bears. We might go higher. Maybe we test the bar 58 low, breakout point. Pullback on 74, really bad follow through for the bull breakout. You can see we immediately tested the bar 72 high. Bears sold the high of 72, trapped on 73, but had a chance to get out on 74. And it looks like they took it. We had buyers into the close of 74. 73 enough up for the bulls for a second leg. Inside bar 75, probably buyers below and sellers above, but the sellers may not come in until up here. Outside bar 76, you can call it a high 1, you can even call it a high 2. We rallied, pulled back a second time, and we are reversing up again. But the problem with buying above 77 or 76 is that it's a tight trading range in the middle of an overall tight trading range. And then vacuum test of resistance on 77, testing the low of 58. Next target is the close. It's a strong bar, but possibly one pullback, 2 legs up, in bad context, high in the trading range, probably sellers above. And then 78 broke out to a new high of the day, and we tested the high of the day. Let me see. So we had a 1-tick breakout. So bar 1 did not remain the high of the day, as it usually does not. Bar 18 remained the low of the day. And getting a bar 18 reversal or a reversal around bar 18 is really common. And it helps when you have good context, like maybe a wedge bottom. Bull breakout 77, but high in a trading range, and then disappointing follow through. We did not break out. We tried to break out, but then reversed. 78, trading range bar, probably buyers below. And then 79, traders bought below 78 for a scalp, maybe looking for a test of the bar 77 close. Not an ideal entry bar, probably sellers above 79. Inside bar 80. Very tight trading range within the overall tight trading range, probably going more sideways. We had a rally and then a failed breakout. This became a breakout for the bears. Maybe we're going sideways before a second leg down, but so late in the day, not worth really doing anything. 81, a little bit more to the downside, testing breakout points to the left. For always in today, using traditional always in, it's never really clear on trading range days. So if you are using always in, maybe in the beginning of the day, consecutive bear bars, crossing the moving average, always in short on bar 4, but you know that there's an increased chance the market's in an overall trading range. So when you get bar 9, it's really a problem for the bears. Sell climaxes attract profit taking, and then you're at the bottom of a trading range, couple legs down, 2 legs here, 2 legs here. So the computers, the algorithms, the traders see a late leg in a trading range a couple of different ways. So that's the problem with being short on bar 9. Because traditionally you see a big bar like 9, you think always in short, but when the market's in a trading range, it's the opposite. So it's the same thing with 10, big bull bar, but bad context, more of a sell to close bar. And then I thought because of context, so it's again not traditional, always in with price action, but possible wedge bottom. I guess it is with price action, but it's not that when I say it's not traditional, always in, I'm talking about consecutive bars with one being big, at least one being big and closing near their highs. We don't have that here, but we have a wedge bottom in a trading range. And so I thought after bar 18, maybe by bar 21, it's always in long. The market's probably going higher. We've had a couple legs down in a trading range. The market will likely test higher. But then after you get a bar like 32, it's a warning. It's a buy climax in a trading range. The upside might be limited. And then obviously up here, it's so tight, it's not worth even thinking about always in. What you're doing is it's a limit order market. You're trading with limit orders if you're trading at all. And always in is stop order trading. So tight trading range all through here. Not ideal to be thinking about always in. And again, if you are, it's sort of like perverse logic where bull breakout up to 58, and that's when you know it might be always in long on a smaller time frame. The bulls maybe need one more bar at least, and that's when you know it's bad. You need to look to sell. And the opposite is true for the downside. Consecutive bear bars, one decently big, both closing near their lows, but context trumps everything. You look to the left, you ask yourself, what did the market do the last time we were here? It bounced, it bounced, it bounced. So do you really want to sell the close of 60? It's really not ideal. For stop order trades today, maybe you can sell below 4. There's a bear breakout and momentum. The bar's getting bigger, crossing the moving average. Your stop goes above bar 3 at a minimum, if not above 1, so you can get this deep pullback and scale in, because look at the context. It's a trading range. And then I thought the next best stop order, probably above bar 18. You don't get triggered until 20. But not the best day for stop orders. The next one, I don't know, maybe you sell below 40, a second reversal, spike in channel, high in a trading range, but all of these trades are scalps. Maybe 1, 2, 3 legs down, bull bar closing near its high, 56, you buy, but it's a scalp. And then 2 bar reversal, 59, sell below, but it's a scalp. And that was pretty much it for me for stop orders today. And then for limit order trades, 5 bar micro channel, sellers above. In this case, we had the deep pullback testing all the way over here. And then you will have some bulls buying below bar 6. You can see they got trapped, and when we retested it, they exited. But not ideal. After a big breakout like this, probably sellers above. But it took a long time. The market did not get above this breakout bar until at least 10, 15, maybe 20 bars later. So at that point, what's happened all the way to the left has less of an influence. What's happening here is more important than what happened here. So maybe there was a sell above this bar if it triggered somewhere here, but it didn't. Buyers below bar 10, bull breakout, low in a trading range, but you're not going to buy the bar 10 close or above bar 10 because you're buying, if you're doing that, you're buying in the middle or high in a trading range. So yeah, it might be a wedge bottom, but the buy is on a pullback. And that's what traders did. They bought the close of 9, they bought below 10. There's limit order trades down here. The market started to rally, 5 bar micro channel, first reversal down, likely to fail. Low 1 with a small signal bar, low in a trading range, buyers below 22. Low 2 below 25, but weak signal bar, still low in a trading range, bad context, buyers below 25. Here, I mentioned this earlier, possible, so it's 3 pushes up, 1, 2, 3. Trendline break, maybe, even arguably not. And then continuation, the bears were hoping 29 or 30 would be a good sell signal bar, but instead 29 bull bar closing on its high, buyers below. A bad stop order is a good limit order trade, and so if it's a bad stop order to sell below 29, you can buy below it for a scalp. That's what happened. We fell below it, the bulls bought, they scalped out. That selling is profit taking by the bulls. And then we did not trigger the sell below 31, and then everybody bought the close of 31. This was not enough to reverse. The market was going higher in this trading range. We already tested low. The bulls have maybe a few legs up here, but on a higher time frame, it's really just maybe 1 leg, 2 legs. And then all through here, I'm not going to go through them all because it's basically all limit order trading in here, where as long as you're selling above a bar or buying below a bar and you're scaling in, you're going to make money in such a tight trading range like that. Even here, you say it's a bad buy signal bar, bad stop order, good limit order. That is true. So you sell above 55, scale in, maybe at the top of the range, or somewhere over here, the open of the day. You scale in higher, and then you get back out at your original entry only about 5 bars later. All through here, same thing. Buyers below, sellers above. Where do we go tomorrow? Well, with the daily chart, the market's in a very tight trading range. I was mentioning last week that we are above the moving average, so that means traders who are buying above the average price for very sideways and average price action. If you're buying when the market is expensive, you don't want this, you want this. You want strong consecutive bull bars, little overlap, high momentum. We're not getting that here. We have 2 legs up, big down, big up, possibly a trading range. So we have a high 1 buy setup today. Actually, you can call it a high 2. We triggered above this bar, the high 1. Stop order triggered. We fell below it. here's a high too. There's probably sellers above today's high, but they may not come in. There are sellers above today's high, but probably scaling in higher all the way up to the top of this trading range. Bad stop order, good limit order trade. And then probably buyers below, but they may not come in until maybe the moving average. There's an increased chance we vacuum down to the moving average probably sometime this week, just because the momentum has gone for the bulls. The market's going sideways. We're going to get to the moving average one way or another by either going sideways or going down. And as always, please feel free to leave questions in the comments for me and include timestamps for any questions specific to this video. Alright, hope everyone has a good rest of their night. Thanks for watching.